Hi all. Whether you're gearing up for your MBA placement interviews, finance interviews, or simply looking to sharpen your corporate finance acumen, you're in the right place. Today, we're diving into a comprehensive question bank on corporate finance. In the next few minutes, we'll explore some of the most frequently asked questions and their concise answers to help you ace that interview. Let's get started. What is corporate finance? Corporate finance deals with the financial decisions that businesses make, including capital structure, investment decisions, and working capital management. Its primary goal is to maximize shareholder value. What is the difference between a balance sheet and an income statement? The balance sheet provides a snapshot of a company's assets, liabilities, and equity at a specific point in time. The income statement shows the company's revenues, costs, and profits over a period, like a year or quarter. Why is the cash flow statement important? It tracks the flow of cash in and out of the business, showing how the company generates and spends cash. It's crucial for understanding the liquidity and solvency of a company. What are current assets? Current assets are short-term assets expected to be converted into cash within a year, such as cash, marketable securities, accounts receivable, and inventory. What's the difference between gross profit and net profit? Gross profit is revenue minus the cost of goods sold, COGS. Net profit, or net income, is what remains after all operating expenses, interest, taxes, and other costs are subtracted from the gross profit. What is the time value of money? It's the concept that a sum of money has a different value today than in the future, based on factors like inflation, interest rates, and opportunity cost. Define the term working capital. Working capital is the difference between current assets and current liabilities. It indicates a company's short-term financial health and efficiency. How is EBITDA calculated? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's calculated as revenue, operating expenses, excluding interest, taxes, depreciation, and amortization. What is financial leverage? Financial leverage involves using borrowed money, debt, to amplify potential returns. However, it also increases the potential for larger losses. What are retained earnings? Retained earnings are the accumulated profits of a company that haven't been distributed as dividends. They're reinvested in the business or held for future use. Why do companies issue bonds? Companies issue bonds to raise capital without diluting ownership. Bonds are debt instruments, representing a promise to repay borrowed money with interest at fixed intervals. What's the difference between accrual accounting and cash accounting? Accrual accounting recognizes revenue and expenses when they are incurred, regardless of when cash is exchanged. Cash accounting recognizes transactions only when cash changes hands. What is depreciation, and why is it important? Depreciation spreads the cost of a tangible asset over its useful life. It's a non-cash expense that reduces a company's taxable income, thus reducing tax liability. What are contingent liabilities? These are potential obligations that might become actual liabilities in the future based on the outcome of a specific event, like a lawsuit. They're recorded in the footnotes of financial statements if their probability is below a certain threshold. Define market capitalization. Market capitalization, market cap, is the total value of a publicly traded company's outstanding shares of stock. It's calculated as share price x number of outstanding shares. What is the net present value, NPV? NPV is the difference between the present value of cash inflows and outflows over a period. It's used to determine the potential profitability of investments. A positive NPV suggests the investment should be considered, while a negative NPV indicates it might not be profitable. How do you calculate the internal rate of return, ER? ER is the discount rate that makes the NPV of a project zero. It represents the project's expected return rate. To find the ER, one would set the NPV equation to zero and solve for the discount rate. What is the difference between NPV and ER? NPV provides a dollar value that represents the expected profitability of a project, while ER represents the project's expected percentage return. What is a payback period? The payback period is the time it takes for an investment to generate enough cash flows to recover its initial cost. It gives a basic idea of how quickly the invested amount will be recovered. What is the weighted average cost of capital, WACC? WACC represents a firm's average after-tax cost of capital from all sources, debt, equity, preferred stock, etc. It's used as a discount rate in NPV calculations to determine the value of a company's cash flows. What are the key methods for valuing a company? The main methods are: 1. Comparable companies analysis, CCA, comparing valuation multiples of similar firms. 2. Precedent transactions analysis, comparing prices paid in similar past transactions. 3. Discounted cash flow, DCF, valuing a company based on its future cash flow projections. What are capital expenditures, CapEx? CapEx refers to funds used by a company to acquire, maintain, or upgrade physical assets like property, plants, technology, or equipment. Why might two companies have different valuations despite similar financial metrics? Differences could arise due to market perception, growth prospects, competitive positioning, management quality, geographic presence, and industry trends, among other factors. How does an increase in interest rates impact the valuation of a company? A rise in interest rates generally leads to higher discount rates, WACC. This can reduce the present value of future cash flows, leading to a lower valuation. How do you calculate the terminal value in a DCF analysis? The terminal value represents the value of all future cash flows beyond the projection period. It can be calculated using the perpetuity growth model or the exit multiple method. What is sensitivity analysis in the context of financial modeling? Sensitivity analysis examines how variations in inputs, like growth rates or discount rates, impact outputs, like NPV. It provides a range for potential outcomes and highlights the model's key drivers. Explain the concept of sunk costs. Sunk costs are expenses that have already been incurred and cannot be recovered. In capital budgeting decisions, they should be ignored as they don't impact the project's future cash flows. What is an opportunity cost? Opportunity cost represents the potential benefit an individual or business forgoes when choosing one alternative over another. How do you prioritize multiple projects with positive NPVs? Projects can be prioritized based on their NPV, payback period, strategic importance, risk profile, and the availability of resources. What are financial markets? Financial markets are venues where buyers and sellers interact to trade financial instruments, such as stocks, bonds, derivatives, and currencies. They play a crucial role in allocating resources and determining prices of securities. What's the difference between primary and secondary markets? In the primary market, new securities are issued to the public for the first time, raising capital for the issuer. The secondary market is where existing securities are traded among investors. What is a stock exchange? A stock exchange is a regulated marketplace where securities like stocks and bonds are bought and sold. Examples include Sensex, Nifty, New York Stock Exchange. Can you explain the term bond yield? Bond yield is the return an investor realizes from a bond. Current yield is the annual interest payment divided by the bond's current price. Yield to maturity considers all payments, including the redemption at maturity. What are derivatives? Derivatives are financial instruments whose value derives from an underlying asset, index, or interest rate. Common derivatives include futures, options, and swaps. They're used for hedging or speculation. How does a mutual fund work? A mutual fund pools money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. It provides diversification and professional management. Returns and risks are shared among investors. What are exchange-traded funds, ETFs? ETFs are investment funds traded on stock exchanges, much like stocks. They typically track an index and offer a way for investors to buy a broad portfolio of assets. How is the price of a stock determined in the stock market? Stock prices are determined by supply and demand dynamics in the market. Factors influencing these include company performance, industry trends, economic data, investor sentiment, and global events. What's the difference between a commercial paper and a bond? Commercial paper is a short-term unsecured promissory note issued by corporations, typically for financing short-term liabilities. Bonds are longer-term debt instruments, often secured and come with a fixed interest rate. Can you explain what futures contracts are? Futures are standardized contracts to buy or sell an asset at a predetermined price on a specified future date. They're used for hedging or speculation and are traded on futures exchanges. What's the difference between a call and a put option? A call option gives the holder the right, but not obligation, to buy an asset at a set price within a specific time. A put option gives the right to sell under similar terms. How does foreign exchange trading work? Foreign exchange, Forex, trading involves the buying and selling of currencies. Exchange rates, or the value of one currency relative to another, fluctuate based on economic factors, interest rates, geopolitical events, and market speculation. What are interest rate swaps? Interest rate swaps are derivatives where two parties exchange interest rate cash flows, often one fixed rate for one floating rate. They're used to hedge interest rate risks or achieve desired interest rate exposure. Why are credit ratings important? Credit ratings assess the creditworthiness of a borrower. They impact borrowing costs, as higher ratings typically mean lower interest rates. Ratings are used by investors to gauge the default risk of a bond or debt instrument. What are junk bonds? Junk bonds, or high-yield bonds, are bonds rated below investment grade by credit rating agencies. They carry higher default risk and, therefore, offer higher yields to compensate investors for that risk. What is capital structure? Capital structure refers to the mix of a company's long-term debt, specific short-term debt, common equity, and preferred equity. It describes how a firm finances its overall operations and growth. Why is the concept of capital structure important? The right mix of debt and equity can optimize a company's cost of capital, maximizing its value and profitability. It also affects the risk and return profile of the firm's equity holders and debt investors. What is the Modigliani and Miller theorem? Proposed by Franco Modigliani and Merton Miller, this theorem suggests that in a market without taxes, bankruptcy costs, and asymmetric information, a company's value is unaffected by how it is financed, whether with debt or equity. What are the primary sources of financing for a company? The primary sources are equity, issued shares, and debt, bonds, loans. Each has its own cost and implications for a company's risk profile. How does financial leverage impact a firm's earnings? Financial leverage can magnify a firm's earnings. Higher interest expenses from debt can reduce net income, but if the return on the borrowed money is higher than the interest, it can increase earnings per share for equity holders. What are the main theories of capital structure? The primary theories include the trade-off theory, firms balance the tax benefits of debt against bankruptcy costs, the pecking order theory, firms prefer internal financing, then debt, then issuing equity, and the market timing theory, firms time their financing based on market conditions. How do you determine the optimal capital structure for a company? The optimal capital structure minimizes the cost of capital and balances the benefits of debt, like tax shields, against the risks, like financial distress. It's influenced by factors like business risk, tax considerations, and market conditions. Why might a company choose debt over equity financing? Debt financing can provide a tax shield, interest expense is tax deductible, is generally cheaper than equity financing, and doesn't dilute ownership. However, excessive debt can increase the risk of financial distress. How do interest rates affect capital structure decisions? Low interest rates can make debt financing attractive due to lower borrowing costs. However, if rates are expected to rise, companies might be hesitant to over-leverage. Conversely, high rates might make equity financing more appealing. What are covenants in the context of corporate finance? Covenants are terms and conditions put by lenders to protect their investments. They can be restrictive, dictating actions the borrower can't take, or affirmative, specifying actions the borrower must take. What is meant by cost of debt? Cost of debt is the effective interest rate a company pays on its borrowings. It is generally lower than the cost of equity since debt holders take on less risk than equity shareholders. What are dividend decisions in corporate finance? Dividend decisions relate to the amount and timing of cash dividends paid to shareholders. They consider factors like retained earnings, reinvestment opportunities, and shareholder expectations. Why might a profitable company not pay dividends? A company might reinvest profits into the business for growth, use them to pay down debt, or buy back shares. Additionally, withholding dividends can provide flexibility in future financial decisions or signal anticipated cash flow needs. What is the purpose of financial statement analysis? Financial statement analysis provides insights into a company's performance, financial health, and future prospects. It aids investors, managers, and stakeholders in making informed decisions. How is the intrinsic value of a company determined? The intrinsic value is the perceived actual value of a company, often calculated using discounted cash flow analysis, multiples valuation, or other valuation models. It takes into account future cash flows and inherent business risks. What are financial ratios, and why are they important? Financial ratios are quantitative measures derived from a company's financial statements. They help assess profitability, liquidity, solvency, efficiency, and valuation, providing insights into the company's performance and financial health. What is the difference between book value and market value? Book value is the value of an asset or company as per its balance sheet, reflecting historical costs. Market value is the current value of an asset or company in the marketplace, influenced by perceptions, demand, and supply. Can you explain the price to earnings, P/E, ratio? P/E ratio is a valuation ratio, calculated as the market price of a share divided by its earnings per share, EPS. It indicates how much investors are willing to pay for each unit of earnings and can be used to compare relative valuations of companies. What is EBITDA, and why is it significant? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It provides a measure of operational profitability by looking at earnings from core business operations, excluding financing costs and non-cash expenses. What's the difference between free cash flow and operating cash flow? Operating cash flow, OCF, represents cash generated from core operational business activities. Free cash flow, FCF, is OCF minus capital expenditures, showing cash left after maintaining or expanding the asset base. What is a discounted cash flow, DCF, analysis? DCF analysis values an investment based on its expected future cash flows, discounted back to their present value using a discount rate, often the weighted average cost of capital. It provides an estimate of intrinsic value. How do you calculate the weighted average cost of capital, WACC? WACC is the average rate of return a company expects to pay to its investors for using their capital. It's calculated by weighting the cost of equity and the cost of debt by their respective proportions in the capital structure. What factors affect the discount rate used in a DCF analysis? The discount rate reflects the risk associated with future cash flows. Factors include the risk-free rate, the equity risk premium, the company's beta, and the cost and proportion of debt. Why are comparable company analyses, comps, used in valuation? Comps involve valuing a company by comparing it to similar companies, using metrics like P/E or F/EBITDA. It provides a relative valuation and is based on the premise that similar companies should trade at similar multiples. What's the difference between liquidation value and going concern value? Liquidation value is the estimated amount of money that could be realized by selling a company's assets and paying off its liabilities. Going concern value assumes the company will continue its operations and not liquidate its assets. How is enterprise value different from equity value? Enterprise value, EV, is the total value of a business, including not only its equity but also its debt and excluding its cash and cash equivalents. Equity value is simply the value of a firm's equity, represented by its market capitalization. Why might two analysts arrive at different valuations for the same company? Differences in assumptions, like growth rates or discount rates, chosen financial models, subjective judgments, and data sources can lead to different valuations for the same company. How do you assess the financial health of a company? Financial health is assessed through analyzing financial statements, ratios, liquidity measures, solvency ratios, operational efficiency, profitability ratios, and external factors like market conditions and industry trends. What is the difference between a merger and an acquisition? In a merger, two companies combine to form a new entity. In an acquisition, one company buys another. The distinction is in how the deal is structured and the resulting entity's formation. Why do companies pursue mergers and acquisitions? Reasons include achieving economies of scale, expanding market share, accessing new markets or technologies, diversifying products or services, improving competitiveness, and achieving tax benefits or synergies. What are synergies in M&A? Synergies refer to the potential benefits resulting from combining two companies. These can be cost synergies, cost reductions, or revenue synergies, revenue enhancements, leading to a combined value greater than the sum of individual entities. How do you evaluate a potential acquisition target? Evaluation involves assessing the strategic fit, financial performance, potential synergies, cultural fit, risks involved, and the price or valuation of the target company. What is a hostile takeover? A hostile takeover is an acquisition attempt that's not supported by the target company's management or board. The acquiring company might go directly to the shareholders, often with a tender offer. Can you explain the term leveraged buyout, LBO? In an LBO, a company is acquired using a significant amount of borrowed funds. The assets of the acquired company often serve as collateral for the loans. It leverages the target's cash flow for debt repayments. What is a poison pill strategy? It's a defense tactic used by companies to deter hostile takeovers. By making the company less attractive or more costly to the acquirer, like by issuing more shares, it makes the takeover less feasible. How do cultural differences impact mergers and acquisitions? Cultural differences can lead to integration challenges, miscommunication, reduced morale, and employee turnover. Addressing and bridging these differences is vital for a successful M&A integration. What is due diligence in the context of M&A? Due diligence is the comprehensive appraisal of a business undertaken by a prospective buyer, especially to evaluate assets and liabilities and evaluate commercial potential. It's crucial for identifying risks and verifying information. What is a breakup fee in M&A terms? A breakup fee is a penalty set in takeover agreements, to be paid if the target backs out of the deal. It compensates the potential acquirer for the time and resources invested in the deal. How do you finance an acquisition? Acquisitions can be financed through cash reserves, issuing new equity or debt, bank loans, or a combination of these. The choice depends on the acquirer's financial health, market conditions, and deal specifics. What is a stock-for-stock transaction? In a stock-for-stock transaction, the acquiring company uses its own stock as a form of currency to purchase the target company. Shareholders of the target receive shares of the acquiring company instead of cash. What are the main challenges in integrating two companies post-M&A? Challenges include combining different corporate cultures, integrating systems and operations, managing employee morale and retention, achieving projected synergies, and meeting stakeholder expectations. Why might a merger or acquisition fail to deliver expected value? Failure can arise from overpaying for the target, underestimating integration challenges, not achieving expected synergies, cultural clashes, poor execution, or external factors like regulatory issues or market changes. What is a white knight in the context of M&A? A white knight is a friendly third-party company that makes a counter-offer to acquire a target company when it's facing a hostile takeover attempt. It's seen as a preferable alternative by the target's management. What is corporate governance? Corporate governance refers to the system of rules, practices, and processes by which a company is directed and controlled. It involves balancing the interests of a company's stakeholders, such as shareholders, management, customers, suppliers, financiers, and the community. Why is corporate governance important? It ensures transparency, fairness, and accountability in a company's relationship with its stakeholders. Good governance practices can lead to better company performance, enhanced investor trust, and protection of the rights of stakeholders. What is the role of a board of directors? The board oversees the company's management, represents and protects shareholder interests, ensures appropriate risk management, and sets broad policies and strategic objectives. It provides oversight, guidance, and accountability for company executives. What's the difference between a CEO and a chairman? The CEO is responsible for day-to-day operations and implementing company strategy. The chairman leads the board of directors, ensuring its effectiveness in governing the organization. Sometimes, the roles are combined, other times, they're separate to ensure checks and balances. How can conflicts of interest in corporate governance be managed? Conflicts can be managed by establishing clear policies, regular disclosure, third-party evaluations, recusal from decision-making where a conflict exists, and strong oversight by independent board members. What is a whistleblower policy? A whistleblower policy encourages employees to report unethical or illegal activities within the organization without fear of retaliation. It provides mechanisms for anonymous reporting and ensures protection for the whistleblower. Why are ethical practices important for a company? Ethical practices enhance a company's reputation, reduce risks of legal issues, foster loyalty among employees and customers, and can lead to better financial performance. They also ensure sustainability and trustworthiness in the long run. What is insider trading and why is it illegal? Insider trading involves trading a company's stocks or other securities based on material, non-public information about the company. It's illegal because it undermines investor confidence in the fairness and integrity of the securities markets. What are fiduciary duties? Fiduciary duties are responsibilities that certain persons, like directors or trustees, have towards others. They must act in the best interests of those they represent, with care, loyalty, and good faith. How does corporate social responsibility, CSR, fit into corporate governance? CSR integrates social and environmental concerns into a company's business operations. Good governance ensures that these efforts align with stakeholder interests, are transparent, and create long-term shareholder value. What are stakeholder rights in corporate governance? Stakeholders have rights based on law or contracts. For shareholders, these may include the right to vote on major decisions, receive dividends, access company information, and participate in annual meetings. What's the difference between a stakeholder and a shareholder? A shareholder owns a portion of a company through stock ownership. A stakeholder has an interest in the company's performance and decisions but may not own shares. Stakeholders can include employees, customers, suppliers, and the community. Why might a company adopt a dual-class share structure? A dual-class share structure allows certain shareholders, often founders or management, to have more voting power than others. It can help them retain control over company decisions, even if they own a smaller economic interest. How do environmental, social, and governance, ESG, factors influence corporate governance? ESG factors are increasingly considered crucial for sustainable business operations. Companies with strong ESG performance often have better governance structures, as they're more transparent, accountable, and aligned with stakeholder interests. How do proxy fights relate to corporate governance? A proxy fight occurs when a group of shareholders joins forces to gather enough shareholder proxies to win a vote. It can be a tool for shareholders to influence management decisions, board composition, or company strategy. Thank you for joining us today on this enlightening journey through corporate finance. Remember, knowledge is power, and practice makes perfect. If you found this video helpful, don't forget to give us a thumbs up, share it with your peers, and subscribe for more content. Drop any questions or topics you'd like us to cover in the comments below. Until next time, keep learning, keep growing, and best of luck with your interviews.